Well, good afternoon. Happy Friday, June the 5th. This is Mark Milam, your mortgage professional, coming to you with this week's interest rate summary and market update. What a week it has been in the United States as we try to come out of this coronavirus COVID-19 situation, all of the health implications, the economic implications, and then the racial tensions and the protests in spots, this rioting that's been happening. Just a tremendous emotional and economic toll being taken on the country right now. But today we got some really incredible news for the economy. Not such great news for mortgage interest rates, but great news for the country and the economy overall. It was anticipated this morning that the unemployment figures would come in a little over 19%, which obviously is Great Depression era markings, right? Indication. So we had anticipated about 19.8% unemployment this morning. At 8:30, that report was released. Much stronger than anticipated. We came in at 13.3% unemployment. Let me flip the screen around here and show you what I'm talking about. So May sees the biggest job increase ever at 2.5 million jobs as the economy starts to recover from the coronavirus. You can see we're at 13.3% unemployment. We anticipated somewhere in that 19% range. Looks like most of the gain is coming from the temporary layoffs due to the coronavirus economic shutdown. What's that doing to the Dow Jones? Well, the Dow Jones is up 890 points as of 12:33 p.m. here on the East Coast. So obviously a tremendous positive impact. We just went up over 900 points now. Tremendous positive impact on the stock market. And there's this old fundamental principle that people like me have followed for the past 15, 20 years that I've been doing this for a living, that as the stock market improves, the bond market typically suffers. Stocks and bonds compete for the same investment dollar. And anytime bonds suffer, well, interest rates start to rise. And that's kind of where we're headed here. Let me show you what I'm talking about. Again, I'm going to flip the screen around. Here are mortgage-backed securities that we track. And green days are good days. Green days are rates are improving, rates are going down. As the value of the security trades up, the interest rate associated comes down. Well, you can see what's happened here over the past 2 days. This is Wednesday and Thursday. Boom, and here we are on Friday with this economic news of unemployment being far better than anyone anticipated. That's causing a huge run up for the Dow Jones, and it's causing bonds to sell off, specifically mortgage-backed securities, and that is going to drive rates higher. Now, let's be clear about what we're talking about when we talk about drive rates higher. You can still get a 30-year fixed mortgage for in the very low threes right now. That's rivaling all-time lows. Maybe not quite as good as we were this time last week, or maybe not quite as good as we were in mid-May, but affordability is still incredibly good in most areas of the country. And we'll have to just track this as we go. And on some products, we're actually seeing some improvement. For instance, jumbo lending, we're starting to see a little bit of improvement. Now, all of this positive news is going to create a sense that it's time for jumbo to begin to re-enter the market. On that note, let's look at one other item here. Let me move all of these windows out of the way and show you the active forbearance plans. And I don't know if you've been watching this this video cast, this vlog, for any length of time, but we've talked about the flattening of the forbearance curve, that it was super important that we saw forbearances start to table out and begin to decline, and we are starting to see that for the first time since the coronavirus epidemic hit, or the pandemic hit. We're now seeing a modest decline right there in forbearances for mortgages. That is incredibly positive news. That's the first major step towards recovery for the mortgage market in full. Obviously, conforming conventional government loans have been in great territory for months and months now, but everything else has been pretty hit or miss. So this is a very positive sign for the mortgage industry and for the country, quite frankly. So I know we've all been sitting in our homes, we've been sitting in our apartments, our condominiums, waiting for the table to turn, waiting for the other shoe to drop, for the economy to start to gin up again. And it appears we've got the first indications now, with forbearances declining, the Dow Jones ticking up on the news of unemployment. So it'll be interesting to track as we go. As always, if I can be of any assistance to you, please don't hesitate to reach out. 404-395-1102. Thanks.